Hello, everyone. Welcome to today's Luohan Webinar. It's CGF from Luohan Academy. So today we are very happy to have Professor Yao Zeng from Wharton School, University of Pennsylvania, to talk about fintech lending and cashless payment. So Professor Yao Zeng is an assistant professor of finance at Wharton School, University of Pennsylvania, and he works on the intersection of asset pricing and corporate finance with a focus on the financial intermediation. Recently, his research has been published on leading journal of finance, such as Journal of Finance, Journal of Financial Economics, and Review of Financial Studies. And Dr. Zeng received his PhD in economics from Harvard University in year 2016. And before joining the UPenn, he was on the finance faculty of University of Washington from the year 2016 and year 2020. So without further ado, Professor Zeng, the floor is yours. Please take it over. You will have about 90 minutes. Please go ahead.
Thank you, CJ, for a very nice introduction. And it's great to be here. Thank you for having me. This is joint work with Pulak Ghosh from Indian Institute of Management and Boris Bali from Harvard, who is my frequent course on fintech topics. And as you can see, we're going to really talk about two keywords: fintech lending and cashless payment. So that's why it's also so exciting to talk to your audience, because I know that you are really at the frontier of understanding those two keywords. Okay, so motivation. Let me first set up stage by telling you what do we mean by fintech lenders, because everybody may have a different idea about what that means. Here, we call a financial institution a fintech lender if it relies on electronic platforms and technologies to screen and extend loans without taking deposits or without developing relationships with borrowers. So those are really the key differences between fintech lenders and traditional banks. So let's first look at some numbers. So in the US, as many people know, fintech lending has been dominating in some of the most important lending markets. In the retail markets now, it's dominating in mortgages, and it's also growing rapidly in small business loans. That's in the US. And we can see a similar trend in Europe, in Asia, and also in China. We know that as well. Obviously, this is something promising, this is something interesting, but conceptually, this is also something surprising and perhaps even puzzling, because again, when you think about the differences between fintech lenders and traditional banks, in some sense, fintech lenders are kind of handicapped, because traditional banks, right, in the lending market, they enjoy at least two channels through which they can produce insight and soft information. Number one, traditional banks, they take deposits, and a lot of borrowers are actually also depositors. And that means that there is an informational spillover across the two sides of traditional banks' balance sheet. By looking at the deposit flows, traditional banks can get a better understanding of the creditworthiness of borrowers, and that's going to make them, and that's going to inform their lending decisions. And number two, traditional banks, they also develop relationships with borrowers in the sense that they can engage in repeated lending. And over time, they can also produce a lot of soft information about the borrowers, and that will also improve their lending efficiency. Again, when you think about fintech lenders, they cannot really enjoy those two channels. They cannot produce insight or soft information as efficiently as banks do. So that's a conceptual question we are interested in. How come fintech lenders can compete with traditional banks in the lending market, especially when we think about this informational perspective? So here is our story. Our story is going to highlight a synergy between fintech lending and outside verifiable information. So now we're going to talk about the first direction, which is the use of outside verifiable information is going to help fintech lenders to screen loans. In other words, fintech lenders, by using better informational platforms, informational technologies, they are better able to get access to and to use outside verifiable information. So intuitively, you can think about any so-called digital footprints, right? So a lot of things you can think about. So you can look at what kind of phone they are using, what kind of newspaper they're subscribing to, what kind of restaurant they go to. But in this paper, we're going to focus on one of the most economically important type of verified information. That's a payment record, because that's presumably, that's most directly linked to consumption, linked to production, that's directly linked to the creditworthiness of borrowers. So you can argue that the better use of verifiable outside payment records is going to allow fintech lenders to screen loans more efficiently, and that would also allow those borrowers who use verifiable payment records to get better loan terms and pricing. So that's really about use of outside and hard information compared to inside and soft information.
Sorry, can I ask one clarifying question?
Sure.
Yingji. I think the fintech lenders and traditional banks are not that different in the sense that they both have some type of information channel. Let's say for the Ant Group or Ant Financial, you will have standard kind of deposit like products like Yuebao. In that sense, the Ant Financial can also observe how much you have, how much money you have on this kind of deposits like product. Then that information will help the kind of firm to make the loan decision, right?
Exactly. That's what they say, right? You are really at the frontier. So yeah, in the US, I would say most of those fintech lenders, they don't take deposits. And they don't engage in repeated lending. But you're right. So we talk about the so-called big tech lenders, right? So maybe you can think about, as you said, right? In China, we can think about Alibaba. We can think about Tencent. In the US, we can think about maybe Amazon, right? So again, they don't take deposits, but they have their own platforms. And on their platforms, those brothers, they can they actually sell things on the platforms, and Amazon can directly look at their production process. And you're totally right. So right now we can see this development of fintech lenders catching up with traditional banks in terms of getting such a balance sheet structure. Right, but that's exactly something I want to argue, because right now, when I talk about this synergy, right now I focus on outside and hard information, but we indeed see a trend of fintech lenders acquiring outside payment service companies, and payment service companies offering lending service as well. Right. So another thing you can think about is PayPal in the US. Actually, they used to focus on payments only, but right now they also extend loans to borrowers. So that's another way of thinking about this, the implication of the synergy I'm going to talk about. But you're totally right.
Yeah, my question is kind of similar, but about the traditional bank. Even before this digital revolution we see in last 10 years, the traditional bank also use a lot of information technology to deal with many hard information. For example, also like the payment data between corporations, and also when we apply credit card, they evaluate you also based on a lot of hard information. So I'm not sure whether such a distinction here is useful or not. Yeah,
that's right. I agree, as you said, right? So we talk about traditional hard information such as credit score, or FICO score. We know that traditional banks rely on such hard information a lot. So here, what I want to highlight is, I'm not highlighting an absolute advantage of fintech lenders using outside hard information. It's more about, I would say, comparative advantage. Because fintech lenders, at least if you look at more, I would say, typical fintech lenders who don't take deposits, who don't engage in relationship lending, it's really hard for them to produce soft information. It's really hard for them to produce inside information. So they really have to have a better informational technology platform, which allows them to have some comparative advantage in producing outside and hard information, right? Yeah, you're right. I'm not saying that this is completely different from traditional banks using FICO score, but I'm saying that fintech lenders, by having this comparative advantage, that will give them an edge in the lending market when competing with traditional banks. Does that make sense?
A very good point. Yeah, and also fits the story here. We observe it's more like because fintech lenders don't have anything else to use. They don't have soft information, or it's too expensive to cover the business model, so that they have developed many ways to either collect, acquire, and deal with the scattered and hard information. Yeah.
That's exactly right. Great. I just talked about the first direction of the use of outside hard information fostering lending, but this is not the end of story, because we're going to show you there's another direction of this synergy, which is the use of fintech lenders. So basically, when fintech lenders rely on outside hard information to make lending decisions, and when borrowers rationally expect that, that's going to encourage those borrowers to adopt the use of verified payment in the first place. So I'm going to be very specific about that when I showed you the model. So there will be interesting strategic interaction among those borrowers to stand out from worse borrowers. It's like when everybody is using PayPal, when everybody is using Alipay, you don't really want to look like a lemon. So you want to use that as well to show borrowers, hey, I'm good, I'm smart. So that's a kind of story we want to highlight. I'm going to talk about that in detail. But that's indeed consistent with the second keywords, right? There is another trend of a rise in the use of cashless payments globally. And everybody knows that in China, right? Think about Alipay, think about WeChat Pay. I mean, we all know the numbers. And one thing we want to highlight in this paper is we want to explain the rise of cashless payments jointly with the rise of fintech lending. So that's how we connect the two keywords of our paper. All right, so what we're going to do, what we're going to bring to the table today is going to present you with this paper in which we first build a theory to show you this synergy between lending and cashless payments. We're going to show you under what conditions the use of verifiable cashless payments is going to improve lending outcomes. That's direction number one. And on the other direction, I'm going to show you strategic consideration among borrowers, which will eventually push more borrowers to adopt cashless payments. And jointly, we're going to give you one plausible explanation for the joint rise of fintech lending and cashless payments. And then we're going to map this to data. We're going to use novel application level data from India, from one of the leading fintech lender in India, to test model predictions. Most notably, what's nice about this data is it contains very detailed payment records of many different types. So there are a lot of different payment technologies we can look at, and that conceptually allows us to look at different information with different verifiability. And most importantly, we can use some unique institutional details and our data feature to come up with an instrument variable, and that allows us to identify the causal effects, informational effects of cashless payments on lending. So in other words, we're going to focus on empirically testing the first direction of this synergy. We show that more verifiable cashless payments is going to lead to higher chance of loan approval, and conditional on getting a loan, you're going to get a low interest rate, and you will also have a low default rate conditional on interest rate, which means that capital allocation will also become more efficient when borrowers use more cashless payments. Okay. So this is a very quick summary of what we do. I'm going to jump to the model. So in the paper, we have a more rich, we have a richer model, more full-fledged model, but today I'm going to focus on a minimum version of that to really help us get to the core, to get to the idea. Okay, so it's a simple model with two agents. We have a risk-neutral firm, so this is the borrower, and we have a competitive risk-averse financier, so you can think of this as the fintech lender. So we have a borrower, we have a lender. There's information asymmetry in that only the firm is privately informed about its type. So that's the true type of the firm. So only the firm knows that. The financier has a prior about the type Z, and the mean is mu, the precision is tau Z. Okay, so this is standard. We have a discrete time model in which we have n+1 periods, and we divide that into two stages. For the first n periods, we call that the production stage. In the production stage, there's no financing. The firm is essentially well-funded, can use its own endowment to produce. So this is all about production. Only at the last stage, the last period, we call that the lending stage. The firm is running out of funds. So the firm is going to turn to the financier to seek finance. So in this model, so we take a reduced form to model debt financing. We essentially model this as the firm selling the product to the financier and getting a price. And we will interpret the reciprocal of that price as interest rate. But in the paper appendix, we also have another more explicit version of debt financing with a similar idea. Okay, the key thing here is at any time t, the firm is going to produce a product of uncertain value yt, which is essentially a noisy signal of the true type. And there's a precision tau y. Remember, so yt, so that's not payment. So that's production, right? That's still not verifiable. That's not transferable. But we can think of this outcome, right? So because there are n periods, so when we summarize all the outcomes for the production stage, we have this vector y, so that's going to summarize all the production outcomes during this production stage. So the most important thing is whether that information is transferable, whether that information is verifiable, and that depends on what payment choice the firm makes at the beginning. So here we model it as, again, so this is a very stuck model. We only think about 2 extreme cases, but we can easily enrich this model. Here, at time 0 at the beginning, the firm is going to choose this payment method to process transactions in the production. It's going to be a commitment. So I'm going to talk about that later. We talk about 2 things. You can choose between cash and cashless payments. In that, if you use cash, your production record will last, in the sense that they will essentially become non-verifiable, they will become non-transferable, so nobody would know that. However, if you choose cashless payment, that means that this technology will generate another noisy signal, xt, conditional on every period production outcome. Remember, that's yt, that's not the true type. That's by itself a noisy signal. Now we're going to generate the cashless payment technology is going to generate another signal, which is verifiable, which is transferable, but it's noisy. But that's the key of this model, because remember, we can think of this as a commitment. When you use cashless payments, you commit to delivering whatever payment records you get eventually to the financier. And this is consistent with reality that, as I said earlier, right, those fintech lenders, they have a comparative advantage in getting access to those information outside. And this is also consistent with the recent development in open banking, in the sense that going forward, right? So it could be even easier for those fintech lenders to get such data from banks who keep records of those payments. Anyway, the key idea here is that,
can I ask a
sure,
very quick question? So if you think about the receipts in the cash world, so if people keep receipts and, well, it's sort of a verifiable payment, right?
Mm-hmm.
Why do you exclude this particularly?
Yeah, sure. As I said, right? So basically, right now I'm talking about 2 extreme cases. So we can talk about the level of verifiability. So cash is not completely non-verifiable. But here, I guess the key here is to really highlight the difference.
Yeah.
So empirically, I'm gonna show you. I mean, there is a whole spectrum, right, of different technologies. So you can think about checks, you can think about cash, you can think about mobile payments, you can think about internet payments, right? So we have a lot of technologies differing in the level of verifiability. But right now, I simply use those 2 extreme cases to capture the idea. You're right. So even cash, right, it's not completely non-verifiable. But here in theory, so we use that as a benchmark.
Yeah.
Hey, Yao. Sorry. Okay. Forgive me.
Ask one more question.
Okay, please.
So coming back to the model, to the model setup. So y actually follows a normal distribution with precision tau y inverse, with precision tau y. So production function is usually stable unless we have a technology shock. But if this tau y is very small, then the variance is going to be large. In this way, the production function is going to be very volatile. So how would you calibrate this precision tau y?
You mean we're not going to calibrate this model? So this is more like, a stylized model in which we capture. Later I'm going to show you some comparative statics. I'm going to show you some predictions, but this is not like a quantitative model. I'm not sure if I completely understand your question. So this is not something we're going to map directly to data, but we're interested in, for example, if you, let's say, if you have a higher tau x or lower tau x, which speaks to the information verifiability of cashless payments, so how that's going to impact lending outcomes. So we're interested in comparative statistics like that. I'm going to later on show you, I'm going to show you predictions.
Thank you.
Okay, my question is about the verifiability, because the background is the difference between hard information and soft information, and we kind of accept that the distinction is whether they can be verified. And I was wondering whether the condition of non-transferable is a redundant condition, because it's either verifiable or transferable or none. Is there any cases which are non-verifiable but transferable?
Yeah, that's a good question. I mean, theoretically, you're right. So, I mean, essentially in this model, so verifiability and transferability is essentially the same thing, especially when we only model two technologies.
I see.
Empirically, I guess it could be that, I mean, when you think about different technologies, they're all transferable, but information content, right, can vary in terms of how verifiable they are. Right, think about, you can think about, later I'm going to show you some of the dimensions we consider empirically, but just to give you a quick example, you can think about checks, right? So you can think about checks versus internet payment. I think both are transferable, right? Because you can always get a copy of a check, and you can always go to your online your bank account, and you can download a statement of the banks, right? But in terms of verifiability, probably they're still different, right?
Yeah.
Okay. Very good. Theory-wise, so they are the same.
Hey, Yao, how are you?
Hey, Luohan.
Hey, how are you? Yeah, good to see you. So I have some kind of questions and maybe a clarification question. This is very nice framework, and I would just want, probably this question is related to what Yingju and Xijie asked. I want to know kind of what's exactly the FinTech element in this model. It's you can also interpret this as kind of credit, right? It's like if the bank, if I borrow the money from the bank kept a record, and I know that if I just borrow from my relative or somebody else and to get a new record, that's from cash. So this basically I can interpret this X as some record about the credit history. Or I can also think about this something like think about a bank has a kind of, if you think about the Y as the hard information, so maybe that's a credit history, credit score, FICO, kind of public information. I can have a loan officer. A loan officer can provide some soft information. So this kind of, that's a model wise. I know this is mainly for illustration purpose, and this is nice. So I want to see your view about the FinTech element of the model. It's probably it's nothing specific about FinTech. It's just about whether you have FinTech provide just some signal that's kind of verifiable, some commitment device. This is one question about the model wise. The other one, I'm not sure whether you know, Wei Xiong has a recent paper about big data lending model, which is an empirical paper. So I got a chance to chair his keynote yesterday at a conference. So in the paper, I think he's using Alipay data. So he found that Ali collaborating with other banks, issue loans, and actually the interest rate of those new loans are high than other kind of the traditional loans or some loans conditioned by traditional banks using also FinTech technology. So the story there is about the liquidity. So the FinTech have information that the data is able to kind of differentiate which borrower can have a good quality, really need the money. So it's more like a term structure. I give you some high yield. I know you will pay for sure. I know that you are a good person. But you really need the money. So that's I use this kind of consumption data to know your pattern, your consumption pattern. I lend the money to you. I charge you high interest. So this is not about the risk. It's a convenient yield. So it seems like probably your paper here is sort of related to their kind of setting is just in India. Your setting is in India. His setting is in China. But it's all about FinTech firms lending money to kind of some borrowers. There's one is in theory kind of conceptual question. The other one is the empirical setting. How these two things reconcile with each other. Stories.
Yeah, thank you, Leah. Yeah, I haven't read this paper. I should definitely look at that, and maybe later on when I present the empirical results, so you can see whether, I mean, how our study is different from theirs. So we can talk about that later. And for the first question, yes, you're right. So conceptually, I mean, in this paper, there's no specific distinction between a bank versus a fintech lender. It's all about the lender, a general lender, and the general borrower. So we're going to really highlight this interaction between lending decisions and the choice of payment. So that's a kind of thing we want to highlight. But you're right. So we may want to potentially incorporate, let's say, competition between banks and fintech lenders. You know, Zhiguo and Jing, they have a paper talking about the interaction between fintech lenders and bank and traditional banks. And I think Uday, Christine, and Haoxiang, they also have a paper talking about competition between banks and fintech lenders. And they are also very nice aspects for us to potentially think about going forward. But you're right. Right now in this paper, it's just about a general lender. And the key thing is I will show you right after. So I'm going to show you something interesting, which is the interaction between payment choice and lending decisions. I think that's probably the contribution we can potentially better claim here in the model. All right, very good. So let me move forward. So this is a choice of payment method at the beginning, and it's a commitment. So let's remember that. And then, so moving forward to the financing stage. Now the firm is going to seek finance from this financier. As I said earlier, we're going to model this in kind of rebuild form. This is like the firm essentially sell the product to the financier and getting a price. So that's going to keep this model more tractable, which means that the financier is think about the break-even point because it's competitive, and that's going to be determined by the expectation minus the variance of this inference weighted by risk aversion. So here, the key point is now the financier may have some information or may not have any information content, but we have to conditional this decision on whatever information the financier has at that point. That's the information set IN we are interested in. And most importantly, I want to highlight that information set contains two parts. So number one is the payment choice strategy. So that's also in the information set. And the actually generated payment records, that's another component of this information set. So that means that we have a standard sequential equilibrium concept, and we can serve that equilibrium. Okay, so I'm going to show you how we do that, and in this process, I'm going to illustrate the two directions of this synergy that I highlight earlier. Good. So I'm going to follow a guess and verify approach to solve the model. I don't want to throw too much math on you, but the reason I want to talk about this solution approach is that's going to allow us, as I said, right, to intuitively illustrate the two-way synergy. I'm going to guess that in equilibrium, everybody is going to use cash. Cashless payments. In other words, nobody will use cash. And later on, so I'm going to first focus on this subgame equilibrium. I'm going to show you the lending outcomes, and later on, I'm going to verify this equilibrium is indeed the equilibrium for the full game. And in this process, I can illustrate the synergy by presenting two propositions. The first one is about the first direction of cashless payments fostering lending outcomes, and the second one is the other direction of fintech lending fostering the adoption of cashless payments. Yeah, so that interaction is something we want to highlight in this model. All right. We're going to talk about the first direction first. So this is proposition one. So that's going to show you how payment information is going to impact lending outcomes. In this model, it's captured by the pricing decision of the financier. It's a super simple proposition, but it's informative because we can solve everything in closed form under this simple model. We can compare this informed price with uninformed financing price, in which nobody used cashless payments. So in this case, the financier can only price the product based on her prior. So that's the mean and that's the precision of the prior. So only prior information enters the pricing decision. But if everybody uses cashless payments, eventually the financier can see the payment records and they can make inference based on such information. And now we see three terms. So I'm going to give you some intuition about this. Look at the first two terms. So this is essentially a weighted average of the prior and the true type. So this is super simple. We call the second term as information revealing effect. And that's because when there are more payment records or when the payment record are more verifiable, that's going to allow the borrower to reveal its true type more clearly to the financier. And that means that in the end, the price will get closer to the true type. So that's the reason we call that the information revealing effect. And there is a second effect, which we call risk-reducing effect. So that's coming from the fact that the financier is risk-averse. So especially if you think about relatively smaller FinTech lenders, right? They may have capital constraint and they may be itself risk-averse due to some agency issue, and they care about risk. So when the borrower uses more cashless payments, so that's going to directly reduce the risk that the financier has to bear. And that's going to increase the willingness to pay. That's going to increase the financing price. So that would translate to a lower interest rate empirically. Okay, so this is our first proposition. It's super simple, but we can perform comparative statics, and that's going to generate some testable hypotheses that we will bring to data. The first one is with more cashless payment records or payment records of higher verifiability, a fund is more likely to be granted loan and enjoying a low interest rate in expectation, and that's fundamentally coming from the risk-reducing effect. Because for an average type of fund, right, the information revealing effect is 0. Right? We think about good types versus bad types. I mean, for good types, they have a positive information revealing effect. That's going to get a higher price for them. But for bad types, they're going to get a lower price. However, on average, there's nothing in terms of information revealing. But for risk reducing effect, that's always positive, and that's going to generate on average a positive impact on their lending and on their borrowing outcomes. So that's hypothesis 1 for an average fund type. And then we can show you that for different fund types, the effect is different. And that's coming from the different information revealing effect. Because again, for the best type, right? So using cashless payments can really help it to get a higher financing price, to get a lower interest rate. So that's the differentiation effects across different fund types. That's hypothesis 2. And finally, we can talk about capital allocation in the sense that more cashless payments or payment records of higher verifiability is going to lead to less default conditional on given interest rate. Again, that's coming from this inference problem because when you use more verifiable information, that's going to reduce inference errors. And in our model, it's captured by, in our empirical context, it's proxied by a less default conditional price.
Can I ask one question?
Sure.
I'm wondering, is there any cost regarding this FinTech option? Let's say cashless payment.
Yeah. In our benchmark model, so I mean, there's no physical cost. So we think of that as benchmark. We really want to focus on the informational effects. But you can easily argue that in reality, right, maybe there is a physical cost, or maybe there is a convenience yield, right? Or maybe there are privacy concerns. So we can incorporate the cost to the model. So that's not going to change the essence of this model. But you're right. In the benchmark model, so there's no cost. So it's all about the informational benefits.
Yeah, so there's no cost, only benefit. So the information revealing thing gonna dominate, right?
It depends on how risk averse the financier is, right?
Okay.
There's still this risk reducing effect, and that's weighted by risk aversion. But you're right. We in our model appendix, so we have a version in which we can incorporate cost. It doesn't have to be cost, as I said, right? Maybe there's a convenience yield, right? Because I mean, it's especially when you think about Alipay, right? Super convenient for people to use that. So that could be a negative cost. It could be a positive cost due to privacy concerns. So, but we're showing the appendix that, so it's not going to change the essence of this model. Hopefully, that's going to lead to richer predictions. For sure.
I have some simple question here. So I guess the kind of the information, the risk reducing, must come from the risk averting of the financier. It's more like the market maker, right? Hit the risk averting coefficient, and if the information is revealing, I guess it comes from kind of something like an unraveling effect. Like people
exactly.
Know the type.
Yes,
so,
yes.
I'm thinking about, so there is some interaction between these two effects. So maybe if I have kind of high type, maybe my risk is higher. So to sort out this the mean and the variance. I think there might be some interaction, so because your prediction is coming from this term is the additive, those terms. And think about it, suppose I'm a project, I have a so the mean is more like my size. If I'm doing some really big business, maybe my risk is also high.
This is actually the risk paid by the financier.
I know, but it eventually will come to me, right? It's kind of they charge me the interest. It's through the market clear condition. I mean, physically, the technology wise, if I'm doing a bigger business, so the size is large, the risk of that is large. When I get money from the financier, the financier maybe also. I think about the interaction between the unraveling effect with the information, the mean, and the risk reducing effect, which is the variance of the financier. That might affect the predictions, right? Hypothesis.
Right. I think technically right now we have this additive structure because we use this simple Cara normal framework. I'm not sure if that's the reason. There's essentially no interaction between those two now. So
exactly. I remember Itai had a paper in JFE 2013. He highlighted if you use the log normal, that will generate the interactions between the mean and the variance. Yes.
That could be the case. Yes, you're right. Yeah, I mean, conceptually, you're right. There could be some interaction between those two. Yes, I'm going to think about that later.
Zeng
Yao.
Hypothesis three. I have a question. It's if I understand model correctly, it's not clear about. You didn't even model default, so
That's right.
I want to understand the logic behind this statement, or you just make some interpretation. That's also fine. Just want to make sure.
Yeah, in the paper we have a formal corollary in which we calculate the mean standard error of this inference. And for the comparative stacks we deriving the paper is we look at the first order derivative of the mean standard error of that inference to n and to tau s. So that's the number of payment records, and that's information verifiability. And we can show that when you have more payment records or when you have a higher verifiability, the mean standard error of the financier's inference gets lower. And that's what we get mathematically. And the interpretation of our corollary is when we map that empirically to default. But you're right. So because right now in the model, right, it's essentially equity financing this model. There's essentially no default. We have another debt version which is less tractable in the appendix, in which we can directly look at default.
I got it. I think I guess the most important part is a conditional on given interest rate. So what does this mean? You're going to think about it in the data. And in the theory,
in the data, we're going to, yes.
In the theory, because the given interest rate already reflected this mean variance, is that right? In your model.
Given interest rate, because there's still a risk reduction effect, right? Because in the end, the financier has to bear some risk.
Indeed. So I thought that the interest rate is going to reflect the tau s. That's right.
That's
a
right.
precision, right?
That's a precision. So tau s, that's a precision of the information technology. and interest rate is going to incorporate that. But in the end, right, in the end, even if, I mean, you get bad information revealing effect, still the financier, because it's risk averse, so it has to bear some risk. Or maybe another way to think about that is at the end of the day, right, when the this could be think of startup as another interpretation of the risk reducing effect. So if the borrower use more cashless payments or more verifiable cashless payments, that's going to reduce the risk that the financier is going to bear.
有 to accommodate 治国 first comment. So could you please consider truncated normal? Maybe the truncated normal is also kind of tractable, right, in this framework.
Oh yeah. Later on, yes, we can consider truncated normal. So we showed you next results. So actually, we can talk about unraveling, and in that, I mean, that part we will indeed. I mean, we can calculate the expectation, and we will indeed follow truncated normal. So to calculate. But I think going back to Drugos' question, I agree. So maybe. I should think about that more carefully. So theoretically, you're right. So because interest rate, I mean, in equilibrium, it incorporates everything. Empirically, so here we do this because we have the control for the interest rate. Theoretically, you're right. So theoretically,
yeah, I do understand. That's why I was asking you whether your theory is very accurate on this point.
That's a good point. Yes. All right, very good. So let me turn to the second direction of this synergy. I'm going to show you an unraveling effect in which the expectation of being screened by FinTech lenders is going to encourage more and more borrowers to use cashless payments. So in other words, we're going to verify that everybody using cashless payments is indeed one equilibrium for the full game. So another way for you to think about this is, again, when you think about information revealing effect versus risk reducing effect, going back to Lian and she just questioned earlier. So if there is no risk aversion, or if, I mean, risk aversion doesn't dominate, information revealing will become dominating. And that means when you think about those low type firms, right? So they're going to get worse off. Because when they use cashless payments, right? So effectively, I mean, they're signaling their weakness to the financier. And how come they're willing to do that, right? So that's a kind of question we have to answer in the full equilibrium. We have to give the justification of using cashless payments, and that's indeed something we want to show you in the model. And the idea goes back to some of the classic papers in the information disclosing literature, and we call that unraveling argument. So think about this. Because the use of cashless payment is a commitment. When you commit to use cashless payments, that means that you commit to disclosing a series of noisy but unbiased signal of your true type to the financier. And that means that if better firms disclose and you don't disclose, you will be perceived as a bad type. And you're not willing to take that outcome, right? Because think about this. Let's suppose there's a cutoff type, and only type above that point use cashless payments. And now think about this. Think about the type just below. Type just below will be very tempted to change their mind to use cashless payments, because if not, they will be perceived as an average type conditioned on this truncated distribution. Right? Because now the financier knows that all the best types, all the better types, they disclose their type, right? Although it's a noisy signal. But by looking at the cash payments, right, the financier knows that, and they were going to perceive anybody without using cash payments as something bad, something worse. So that means that for those types of patterns, they're going to change their mind, they're going to switch to cash payments, and that's going to lead to a new cutoff. But again, this is not in equilibrium, because that means that any type right below that will be tempted to change their mind, switch to cashless payments, and we can have a new cutoff. This unraveling argument will follow, and eventually we have everybody adopting cashless payments when there's no cost of adopting. Again, going back to Shiji's question, right? If there's a cost, so we may have some people who don't use cashless payments. So that's possible, and that's probably more realistic. But when we have this benchmark, so that's going to really allow us to show you this idea of why the rational expectation of being screened by fintech lenders is going to encourage borrowers to adopt cashless payments due to this strategic consideration of standing out of worst borrowers. So that's a key. Okay.
Yes.
Yes.
It's kind of related the discussion of so-called digital divide. So for those who, for some reason, either from cost or just for some industries, hard to apply the digital technology, eventually the gap between them and more efficient ways getting larger and larger. I'm curious whether you found such evidence later in the empirical part or more like a theoretical prediction.
Yeah. I mean, right now we for this part, so we mostly focus on the theoretical prediction because we view this as a prediction for the long run. Right, so in the long run, when you think about any technology, think about adoption of new technology. So one reason of fast adoption could be indeed that people don't want to look like a lemo, right? So if you don't use iPhone, if you don't use Alipay, so people will perceive you as a weak guy. So and that's going to push you to use that. But you're right. So when we think about this prediction, so at least for today's presentation, we're thinking about some tests to potentially address to detect this pattern empirically. But for today's talk, so I would pretty much focus on testing the first direction, which is cashless payment fostering lending. And for this one, so we view this as speaking to the long-term trend of adoption of cashless payments. Okay, good. And this is exactly something I want to talk about. So now, to recap the theory, right? So we have two key propositions, which jointly imply a synergy between lending and cashless payments. And this has implications on some most recent developments in this field, talking about data sharing and open banking. Our model suggests that this process can be self-enforcing because of this synergy on both directions. All right, so let me go to the empirical part, focusing on proposition one, testing the three hypotheses we just derived. Even there, right? So even when you just think about the first direction, the empirical test can be challenging because of some well-known challenges here. Number one, most existing bank lending data, right? They only have data about approved loans. They don't have a counterfactual. And even if you have the data from the bank, typically you can never observe what kind of outside information those banks actually rely on. Again, right, going back to Ingrid's point earlier, right? Maybe some traditional banks, they can also look at some outside payment records. They can look at their, let's say, firm's logbook, the order book, but still, I mean, as econometrician, right, it's typically very hard to get such data. And finally, payment method choice is subject to endogeneity issues, so it's generally hard to identify the causal effect of payment choice on lending decisions. So that's the reason why the effect of cashless payments fostering lending, although the idea is intuitive, evidence is actually quite rare in the existing literature, and that's how we can potentially close the gap empirically. So the data we use is coming from one of the largest Indian fintech lender called Indify. We got all loan application data across 4 years, which means that we can look at both successful applications, which are eventually extended along, versus all the unsuccessful, the rejected applications. So we can have a counterfactual here. And for loan level data, we observe loan amount, interest rate. We also observe the default status at the end of the sample. So that allows us to talk about default. At the application level, we have standard controls. We can observe industry location, those standard firm characteristics. We can have credit scores. So in India, it's called CIBIL score. So that's the Indian version of credit score as standard control. So that's a standard version of hard information. And we're interested in knowing how the use of cashless payments is going to contribute to their lending decisions on top of such standard public hard information. And obviously, we observe decision to offer a loan. And most importantly, we observe the payment records that Indify actually observe and use in their lending decision. And the reason for us to get that data is because Indify specifically require all the applicants to submit 6 months of bank statements, which contain past payment records. This is interesting because I want to highlight something here. In the model, right? In the model, the lender can get access to outside information, outside payment records. Now, this is still outside, right? So this is not something InDeFi, the FinTech lender has initially, but it's coming from traditional banks. In our empirical context, right? It happens that we get the data from InDeFi's access of bank statements. That means empirically, our context also allows us to speak to the recent trend of open banking. Because in this context, right, so the FinTech lender get access to such information through open banking. This is just one way of them to get access to outside information. There could be other ways, right? So, our empirical context doesn't suggest that open banking is a necessary condition for the synergy, but it could be an important channel for FinTech lenders to get access to outside information. Okay, and that's also important. Yes.
Yeah, this is good. So, suppose I'm only using cash in the following sense, and I'm still using bank, but withdraw cash. You do get those records, and we'll see that those will be discriminated against.
Yes. Your data, we can see direct cash deposits or withdrawal from the bank statements. But the key thing here is it's not very verifiable. So here I'm going to show you what we mean by information verifiability, because what's interesting in India is you can always see cash deposits or withdrawal, but you can never see the reason. That's probably the same thing, right? In the US or in China.
Yeah, it's everywhere. It's everywhere. Cash has to see, right? You just don't know where to go.
Exactly.
Good. I'm gonna wait. Thank you.
Yeah. But this is exactly something I want to highlight now, because at the end of the day, right? So conceptually, the model, right, is a stylized model in which we just highlight cash versus cashless. But as I said earlier, it's really about how verifiable they are. Empirically, we can look at a lot of different payment types. In this context, we can look at cash. We can look at certified checks, we can look at internet banking transfers, mobile banking, and POS machine transfers. And the first, classification we do is we use text analysis to first classify cash versus verifiable cashless payments. And generally, as you can see here, verifiable cashless payments, they're generally...
Here's a very important clarification. Sorry, that given what you see, what do you see?
Yes.
And
exactly.
what these banks see. Or what the InDeFi see. Sorry.
Yeah.
I think that's very important.
Exactly. Here, we as econometrician, we have the same information set with InDeFi. They give all the data they get to us. So we are on the same page with them.
Are you serious?
Yes.
Like their daily transactions with names?
Daily transaction with the name of the recipients, with the amount identified by transaction level, and we call them information. So that's an important thing we do empirically, which is we first classify between cash versus verifiable cashless payments, and then we further classify verifiable cashless payments into two categories. First one, which we call information intensive, and there are two things we highlight. Number one is we can identify the recipients. We can exactly know where the money goes, where the money comes, and we can identify the amount at the transaction level. So only when those two criteria are met, we call that information intensive transaction record, versus information light, in which either the recipients are not identifiable or the amount is kind of aggregated. For example, in India, so if you use mobile app, so essentially the bank statements, actually they don't document all the transaction level records, but they aggregate. So when the mobile app transmit the data to banks, they aggregate that information at the daily level, which means that's less verifiable compared to for example, internet bank transfers, in which we have a detailed data appendix in which we talk about details. But the key thing conceptually are those two dimensions.
Sorry to interrupt, but I think it's maybe helpful to understand the loan decision. So what's the typical size of loan we're talking about here? And also whether it's a collateral or it's just a credit loan.
Good. There's no collateral. So they are all unsecured loans. And the term is typically 3 to 5 years. And the size, that varies a lot across industry. So we have a summary statistics table in the paper, but it could be I think the highest we observe, it could be more than to the equivalent of US dollars. That could be more than let's say a 5-year loan. So the highest I should say that's 800. No, so a 100,000 US dollar. Yes.
Oh, I see.
Yeah. Yeah,
That's a lot.
it could be quite large. Yes. All right. Very good. So let me go to empirical results. Okay. So I'm going to first talk about the effect of the use of cashless payments on lending outcomes. Remember, our first hypothesis is this is really about risk reducing effect on average. With more cashless payments or payment records of higher verifiability, the firm is going to be more likely to get loan and is going to enjoy lower interest rates. So here I'm showing you a very simple illustration of the relationship between offered interest rate conditional on getting a loan and the share of verifiable cashless payments. As you can see, when the borrower uses more verifiable cashless payments, they're going to enjoy a lower interest rate. Obviously, this is only conditional sample of successful applications. We can run formal regressions on the pool of all applications. Now, as you can see, right, we have a lot of controls. We have borrower controls, industry, application amounts. This is Indian version of credit score. We have zip code, revenue, this side, a lot of controls. And after all the controlling, we show that when you use more verifiable cashless payments, so this is the share of verifiable cashless payments out of the total payment records on your bank statements. And when you
Would
have
you
a
think
high
the total payment record also important?
total, you mean the absolute number, right? So of total.
In some way, total information.
Yeah, you're right. I mean, here we think of that as a control, but you're right. So actually, we do have another regression.
What control? I don't see the control. What do you? I'm just thinking that you have two kinds of information.
Yes.
One is more accurate. You're going to say like traceable. The other is
Yes.
non-traceable.
Yes.
I would say that both going to matter. Is one is the total volume. The other is the better information. And I don't see you controlling it.
Yeah. Right now, the total number is included here. So total number of payment records is included here, and here. So because I mean, obviously, this is the share of verifiable, right? And the benchmark is cash. So that's not in the regression. But the key point is compared to cash. This is the comparative outcome, right? So compared to the use of cash, if you use more verifiable payments, you're more likely to get a loan, and conditional on getting a loan, you're more likely to get a lower interest rate. But you're right, the total, I mean, yeah, we could possibly report that result as well. So the total number of transaction records, so that I remember that does have a positive effect as well. Sorry. Okay, good. So this is another thing I want to highlight, right? Because as I said, it's not really about cashless versus cash. Conceptually, it's more about how verifiable your information is. So that's the reason we really want to distinguish between information intensive. As I said earlier, what's information intensive? So those are the payment records which you can identify the recipients. You can exactly know where the money goes, where the money comes, and you can exactly identify them at the transaction level, but not at the daily level or other aggregated level, versus information light, in which the information is not that verifiable. And you can see that the effect is mostly driven by those information-intensive payments. Actually, what's interesting here is when we saw these results first, we also think of that as quite surprising. This means that compared to cash, a higher use of information-light payments, from which you can never identify the recipients or the information is aggregated, the borrowers may be even penalized compared to cash. So they're less likely to get a loan if they use too much information-light payments, conditional getting a loan. I mean, this is still a positive effect, right? So they still get a lower interest rate, but obviously the positive effect is also smaller, which means it's not just about cash versus cashless. It's really about the information content. It's really about how identified the lender eventually observe from the payment records you submit. It's all about how much risk they think they have to bear at the end of the day. All right.
Yao, can I ask a question?
Yeah, sure.
So are these all cross-sectional regressions?
The panel regressions. Yeah,
It's
we
panel
have
regression.
yes, we have time fixed effect, and we have cross-sectional contrast as well. Sorry. Yes. Because we have an application bounce fixed effect.
Yeah. So if a borrower borrows for multiple times, then you can control for the.
Yeah, unfortunately, we don't have much repeated lending in this context. So that goes back to our early argument that the lender doesn't actually develop much relationship with the borrowers.
So the lending decision is basically one time, as long as the loan is.
At least for the sample period we look at. So
Okay.
yeah.
Yeah, that's very much different from what we have here.
Yeah, I guess this is probably also true in the US. So when you think about most fintech lenders, because I guess probably the most important reason is they are still pretty young, and some of them actually focus on the so-called unbanked group. So those borrowers actually, they don't have any bank relationship, they don't have any FICO scores, and they really have to rely on those fintech lenders. And they go to fintech lenders and get a loan, especially for mortgage, right? So that's another reason probably repeated lending is not that common for some of those.
Do you know the term of these loans?
Yeah, 3 to 5 years.
Oh, okay, that's really
that's probably another reason why repeated lending is not very common, because we only have 4 years of data.
And I just checked that this company just started in 2015. So you guys get everything.
Exactly. Wow. Okay, all right. So let me turn to the application. So now you may still worry that the share of cashless payments may be subject to management error, maybe subject to selection bias, and especially when you take into account the unraveling argument, right? So you may think that, okay, so better types, they may want to adopt earlier, and worse types, they may adopt later. So obviously that's a concern, right? So that means that to deliver any causal effect, so we may want to come up with some better identification strategy. So what's nice about our Indian context is we can use the Indian demonetization in 2016 as an instrument. We're going to instrument the share of cashless payments with an indicator for banking with a currency chessback, where Indian banknotes and coins are stored and distributed. I don't want to go into too much details, but I'm going to show you a simple illustration of the idea. What do I mean here? So it's not about the destroyment, right? So remember, so when you think about demonetization in India, what happened is at end of 2016, the Reserve Bank of India, the first recollect all the banknotes, all the cash, they destroy them, and then they redistribute new coins and new cash to people. However, there's an important institutional detail here, which is they distribute cash through what we call current chess bank. So that's a special type of bank through which the Reserve Bank of India distribute cash. And for the borrowers who have a banking relationship with those currency chess bank, they're gonna get cash faster and sooner compared to another otherwise identical borrower who only has banking relationship with a non-currency chess bank. So that allows us to run this IVA regression, because now after the demonetization, we look at data in, let's say, 2017, 2018, we can essentially compare two otherwise identical borrowers. Now, the bank borrower A has a relationship with currency chess bank. So the reason for us to observe that is, again, because we get the bank statement data. We know exactly which bank they have a relationship. So we predict that for borrower A, who has a relationship with currency chess bank, they're going to mechanically have more cash payments in the bank statements, versus borrower B, who doesn't have a relationship with a non-currency chess bank, mechanically, they're going to use less cash. So that's the idea of this instrument variable, because that's an exogenous shock to the use of cash versus cashless payments after the demonetization, depending on whether they have a relationship with a currency chess bank versus not. So as I said, right, so exclusion restriction is likely to be satisfied because the demonetization is largely unexpected, and the identifying assumption is essentially that matching between firms and chess banks is orthogonal to unobservable firm quality. And we think of that as being met as well, because what's interesting in India is those so-called currency chess banks, they're not really the best bank. They're not really the biggest bank. They're pretty much random banks. And the idea is intuitive, because when the Reserve Bank of India redistribute cash, they indeed want those banks to be as random as possible to help people get access to cash as easily as possible. So that means that both conditions are likely to be satisfied, and I'm going to show you the result. So we have two stages. In the first stage, we run a regression of the share of cashless payments on whether the borrower has a bank relationship at a currency chess bank. And here you see this very significant negative coefficient, which means that if you bank with a chess bank, mechanically, you're going to use more cash. In other words, mechanically, your share of cashless payments are going to be lower. So that's like an exogenous shock to the share of cashless payments. So that's the first stage. And so this is, I mean, we have two specifications. The first one, we only look at the dummy variable, whether you have a bank relationship at chess bank, and we look at the final specification as well, depending on time. But generally, the idea is the same. So the first stage, so we have a negative relationship. If a bank with a chess bank, you're going to use less cashless payments. And then we use instrumented share of cashless payments to predict the likelihood of you getting a loan, and you see a significant positive effect. Again, that means that when you use more cashless payments, especially after demonetization, if you don't bank with the chess bank, right, it's like there is a positive shock, exogenous shock on the cashless payments. So that's going to generate a higher likelihood of loan approval. So that allows us to speak to the causal impact of cashless payments on loan approval. And we have other final regressions on other outcomes as well, but this is the basic idea how we identify the effect. Okay, and then we can very quickly talk about other predictions of this model hypothesis too. So that's about the different differentiation effects, right, on different firm types. As you can see, we can I mean, later on, I'm going to show you, right, so what's a proxy for firm type. But generally, this is comparing, if you compare better firms, so those are black dots versus red dots, those are worse firms. So generally, when you use more cashless payments, the effect is stronger for those below median risk firms. Those are better types. Those better types, they are going to enjoy from the use of cashless payments more because they will enjoy a larger information revealing effect. And empirically, we capture the type by the weekly revenue volatility, right? The idea is simple. So if you have a higher volatile revenue, generally you're more risky. So we look at interaction. That means that when you have a higher revenue volatility, the effect of use verifiable cash payments is going to be lower. So again, so that speaks to the differentiation effect, and generally for those firms, right? If you are riskier, you're going to get generally you'll be charged as a higher interest rate because this informational revealing effect, right, really help the lender to get a better understanding about their fundamental risk. So this is the differentiation effect. And we can, again, so we can show you, it's not just about cash versus cashless, but really about information content. So I can show you here, the effect is really driven by information intensive payments. So those are payments in which you can identify the recipients, in which you can exactly map them at the transaction level. All right, and finally, this is hypothesis 3, right? Going back to Zhiguo's question earlier, so I'm going to show you the relationship between payment records and default. So here is the result. Conditional on all the earlier controls and interest rate. So this is pricing, right, by the lender. This regression shows you if the borrower use more verifiable cashless payments, eventually there is a lower default rate. So this means that capital allocation is also more efficient because of the use of cashless payments, right? This really allows the lender to gauge the fundamental risk of those borrowers better.
When do you measure the share?
The share?
At the loan origination or ex post?
This is all the
default are going to be exposed.
Default, that's also exposed, exactly. But the share is measured by, I mean, because we have all the payment records. Well, all the payment records
do they
6 months.
keep getting in? Like these, when you apply, obviously I need to submit the application. Later on,
Yes.
during the process, do I, as a borrower, do I need to?
No, there's no monitoring. There's no monitoring. It's all about screening. There's no monitoring. It's all screening at the beginning. And then when you get a loan, you're good. So if you don't default, that's good. If you default, they know nothing about what happened after the application point.
I see. I wouldn't worry in this context that just try to get it. It's a short, so whatever the default seems to be those people who like have a short history. Is that?
You mean because
when you do the borrower control, what kind of things you put in?
Oh, the borrower control, right? So those control again. So those are all at the application point. So those.
I do understand that, but
yes,
I gotta clarify that with this timing, which is good. Now I'm shifting my question slightly, which is what are the borrower control in your mind, in your regression?
The borrower controls. So basically, we have like industry, location, and we have the age of business, and we have the credit details. We have those are the kind of standard firm characteristics included as control.
Okay, thank you.
Yeah, and for payment records, right? I mean, I'm not sure if that's something you're asking, but actually, because we have all the details, right? We have all the text. We can potentially include more controls through this text analysis. For example, because we can identify those recipients, right? So we may potentially control for the purpose, right? So of the payments, we can potentially, I mean, control for the amount of the payments. Right now, we haven't checked those detailed information so far, but we only use the share as a summary statistic to capture how verifiable the payment records are. But we can potentially look at those detailed things. All right. Okay. Before I conclude, let me show you one additional result. So this is earlier, right? So we talk about lending and cashless payments, but the idea is actually general than that. It's not just about payments, right? It's not just about bank statements. It can be as general as any verifiable information, right? Think about Alibaba, think about Amazon, right? It could be just marketplace records in the sense that if the fintech lender has access to, let's say, if those sellers, if those borrowers, right, as producers, they sell things on marketplaces like Amazon, right, in the US, in India, right, they're also marketplaces. And if the lender can get access to their merchant payment records from those outside marketplaces, they may, I mean, similarly help the lender to better predict their creditworthiness, and they may similarly lead to a better borrowing outcome, right? So that's, I mean, that speaks to, I mean, the generality of this framework, and that's indeed the case. So, I mean, what's nice about our data is we also get an alternative source of data, which comes from their marketplace records. So in other words, when those borrowers as producers, they sell their products on online marketplaces, right? You can think of them as Taobao, as Amazon. And when we include those merchant payments, which again, so that's not like cash, right? Because they are verifiable, right? They are online records. And we can include such information in the decision making as well, right? We can check whether that has any impact on the lending outcomes, because those information, so we actually get that information from Indify as well, and that's indeed something they also look at on top of cashless payments, right? The share of cashless payment, and that's indeed the case. On top of the share of cashless payments, right, which they get through bank statements, they also get other source of verified information, and that information indeed plays a role in their lending decisions. When you have a higher share of merchant payments over those marketplace platforms, that's going to lead to a better chance of getting a loan, and that can also predict a lower default. So that means, again, so when we think about open banking, when we think about getting payment records, they are important, but they are not the necessary condition for this synergy to work. It's about the general sense, right, of verified information. As long as you can get any type of verified information from the outside, so that's going to help you. That's going to help fintech lenders, and that's going to generate this synergy. That's going to foster people to adopt such cashless record, right? To adopt those digital footprints.
Have you ever tried using? Have you ever tried to use, for example, the loan amount and regress that on the sharing of cashless payment? Because if the loan amount is larger, then it's less likely to use cash. And while in this econometric setting, how about in a dynamic background using a dynamic panel? Because this time the enterprise or the firm gets a loan, then the next period is going to be easier for him to get the loan again, no matter what kind of payment method he uses, right?
Yeah.
You want to argue this approved loan, the ability of getting the approved loan is really coming from the cashless payment, not from a dynamic setting. Or
you're right.
The amount of loan.
Yeah, that's a great point. Yes, number one, we can definitely look at that. That's a good suggestion. So we're going to look at loan size, right? So either as a control or as an outcome variable. I mean, our context, right? So it's like a requirement. So typically, I don't think there's any renegotiation. So between the lender and the borrowers, it's like, I mean, I request a loan. Let's see. 10,000, I request a loan of that size, and then the lender is going to tell me, okay, so great, you're approved, so I'm going to give you this size of loan, or are they going to reject? So I don't think there's adjustment, but I can double check that institutional detail to check if the loan size could be different from the request initially, and whether the share of cashless payments is going to affect that decision of loan size. So that's a good point. And then you're right. So we may want to argue that even if repeated lending is possible, right? Even if in the future those borrowers can get another loan, still the share of cashless payments is going to play a major role. It's not about the shop information, right? Or it's not about that relationship. I mean, in the end, I don't want to be too aggressive in this aspect, right? As I said earlier, I'm not saying that fintech lenders cannot do relationship lending. I'm not saying that they cannot produce soft information, right? It's just that they have a comparative advantage compared to banks, relying on hard information, relying on information technology. It doesn't exclude the possibility of banks using the same thing, right? So using technology, using outside information. It also doesn't exclude the possibility of fintech lenders using soft information. All right, so let me, yeah, sure.
Last question. I'm a little bit skeptical about the result of default. First, the observation is significantly smaller than the total. It seems like
that's
only
right, because we have to conditional on approved loans, right?
The term, right? And also the total default rate is like 7%. That makes me wonder. So usually when they default, what's the kind of a loss? So I mean, so it's kind of related to we want to justify how the loan decision is made, but it should be somewhat sustainable in terms of business, right? And now we only observe 15% of the loans are already finished their term, and 7% have already default. So to what extent we think that these loans are made somewhat rationally?
You're right. Yeah, I mean, unfortunately, I guess this is something
Can I see
Yeah.
the summary statistics that Inju is talking about? The default rates. I didn't see the overall default.
It's in the paper. I'm not
The
sure
paper.
whether it's in the
Oh,
slide.
I'm sorry. So how
sorry,
big
I
is the
didn't-
default rates?
I think the average is 7%.
It's about 7%, yeah, in our sample. But you're right, because a lot of loans is simply haven't matured yet. So this is just a noisy measure, right?
7% is cumulative, or just every year?
Accumulated.
Among the 9,000 loan,
Yeah, so
Cumulative.
which already finished their term.
How big is the Ali? And
About less than 2%, 1.5 maybe, around less than 2%.
yeah, because the only, I mean, one thing which, let's see if I mentioned that. Yeah, because we can only observe the default status as of September 2019. That's the end of our sample. I mean, unfortunately, I'm not sure if we
let's
can
make
extend
this even worse, no? It's like usually if you cut the snapshot as early as possible, then you shouldn't see.
Oh, that's right. That's right. Yeah, I was saying. I mean, we may potentially extend our sample, right? So we can ask for
And it will be even bigger.
Yeah, that's right. Yeah, but right now this is you're right. We only have a snapshot of the default status. We don't know the time at which the actually default. So if we know the timing, so that's going to allow us probably to run that regression more accurately. Because we know which loan was defaulted earlier, which loan was defaulted later. So that's going to give us additional information, right, as econometrician to test how much information. For example, so if we had that information, right, of the timing, so we can essentially run a regression of the time at which the default on the share of verifiable cashless payment. But unfortunately, we don't have that information. We only have a snapshot. Yeah. Yeah, this is something we can potentially improve. So by getting more data going forward.
Yao, can I make a detailed comments on this IV?
Sure.
I thought this IV thing is the very, it's probably you want to sharpen it even further. I'm not an expert in India, but this result is very, very, very informative at this point.
Thank you.
Now, I don't, because I don't know the details. So is this possible that you do have this network effect where somehow that if you use more cash, you will get a less business?
You use more cash, you're gonna get less profit or
business. It's like, you know, if you think about it, if you know, initially I never use Alipay, but when I get back to China, I have to use
that's right.
this network
Yes.
effect.
Yeah, you're right.
To what extent that when you're identifying these, I would guess that for borrower A, because I don't know if it's an option or actually have to use cash, probably is the option. So that's why you need to fill in more details. That the borrower A somehow has this inclination to use A, and somehow that will not affect its own partners.
Gotcha. I guess you're saying when they get more cash, right? Because I mean, in India, because there's such a large, I would say, black economy, right, or informal sector, right, in which only cash is accepted. So maybe when those borrowers, right, who bank with currency trust bank, they get more cash, maybe that's going to encourage them to do more informal business. Maybe that's gonna, maybe, and that could impact their business model. And that could be taken into account in the lender's lending decision, right? Is that your point?
So it's along the line, but I just want to spend more time on that and look at the timing. So the 2016 has no effect in the first stage.
Yeah, that's before the demonetization, because demonetization was November.
It was 16, no? Oh, November 16th, I see.
Yeah. November. There was November. So there's no effect, but only after. What's interesting is this is non-monotone, so we're still thinking about why. But
it's also the fact that I thought that they revert back, right? It's like
yeah.
Like
I mean, eventually.
One year later, 1 year.
It's
1 year
later.
Like, yeah. So I'm interested in knowing that after 3 years, you still see big difference.
Yeah. Unfortunately, right now we don't have enough data to tell that. But what's interesting right now is the strongest effect actually happened 1 year after the initial shock. It's not right after. So right after there is an effect, but it's not the strongest. And then it gets the peak in 2018, and then it gets reversed in 2019. Yeah. I mean, this is consistent with some recent research talking about the persistent effect I think Gabriel Chododovich in his courses has a paper published at the QJE talking about the long-term effect of demonetization on technology adoption, on production, and they also find this non-monotone effect. Which means that the actually
the opposite. It's opposite of technology adoption.
Yeah, exactly. Yeah.
All right.
Yeah.
Anyway.
Yeah, there's some initial. Yeah, but
digging deeper, I think this is a part of it.
Yeah, sure. This is exactly something we're working on right now. Yeah.
Hi, Yao. Can I ask?
Sure.
Maybe make another point. So so when we see one observation about one loan is approved or not, actually it will be driven by both the demand side and the supply side. So if we are talking about the information effect of the payment flow, we're talking about the supply side. That is, the banks know better about the borrowers and then lend them. But actually, there can be some selection issues about when and whether these borrowers would decide to apply for the loan.
That's right.
So, for example, if the ratio of the cashless payment is correlated with the financial literacy, then for the ones who have high financial literacy, then they might know better when is the best time to apply for a loan. However, for the ones who have low financial literacy, they might just apply for it randomly, and this will lead to a decrease in the approval rate. So it can be there are some confounding factors from the demand side, and I think that could be helpful if you discuss more on that.
Right. That's a good point. Yeah, I agree. I mean, different borrowers, they may think about the best timing, right, for them to get a loan. Right now, I mean, your current framework, we pretty much focus on the supply side by controlling, as you can see, right, we have all the borrower controls, we have the time control. I mean, essentially, it's like we compare two borrowers, right, which are otherwise identical, and they apply at the same time. So, but you're right. So maybe there's still some demand characteristics we cannot fully control, and they can potentially drive the results. I guess that will probably require a more structural approach, right, to decompose this demand effect from the supply effect.
Yeah, that would be helpful. And yeah, and actually your data can do some analysis on that. So instead of looking at whether the loan is approved or not, you can check the timing of these loan applications, and your data can allow you to do this kind of analysis, and I think it can reveal some interesting findings.
You're saying so in our sample, right? So in this.
Yeah, in your sample, it just checked
in the 4-year horizon, right? So we check what characteristics can predict a lender can predict the borrower to apply earlier.
Yeah, exactly.
Later, right? Yeah. Something like that.
Yeah, exactly.
Yeah. That's interesting. We can definitely think about that. Yeah. That's a good point. Yes. All right. I think we are essentially done. Yeah. Thank you so much for all the interesting questions and useful comments. Yeah, I really appreciate it.
Yeah, thanks, Yao. It's a really interesting paper. And is there any more questions from the audience? Okay, then I guess we can conclude here. So thanks again, Yao. It's a great paper
Thank you.
and great
Yeah.
presentation. We learned a lot. Hope to see you soon in our future webinars. Yeah.
Thank you again, Shijie. Yeah. Thank you all. Great seeing you here.
Thank you.
Thank you. Thank you.
Have a great night.